Let's talk today about money and emotion.
You're telling me that money is an emotional thing?
Pretty amazing. I think it all boils down to either fear or greed. At least be aware that you have these bias. When it comes to financial success, there's more than one way to skin the cat. There's really 4 major themes. One of those is overconfidence. Market's going to go up, it's always going to go up. The other one is cognitive dissonance, when you're conflicted about your beliefs. Then there's the other one is regrets. And then the other one is that the prospect.
One of the signs is overspending. Sometimes not recognizing that when the value of your assets are up, then you feel really, really good.
Welcome to Wealth Strategies Unleashed with Concenture Wealth Management. I'm Robert Gilliland and
I'm Mike Alexander.
Hey Mike, great to have you with you. By the way, I think I've got to think of a better way to kick this off other than welcome.
I'm going to leave that up to you. But everyone is always welcome. So good
yeah,
start.
but we just got to think about that, right? I just don't understand if the psychology
I always took you as a greetings and salutations guy, but maybe I've got that wrong.
Well, I was actually trying to give us a hook and a segue there. Let's talk today about money and emotions and the psychology of.
Wait a second. You're telling me that money is an emotional thing?
Pretty amazing. Pretty.
And all this time I've been trying to think logically about it.
I mean, there's a whole area of study, as you well know, that goes into how people react and view money. And I think it's really good for us to kind of share, because I think that if people get aware of the different types of way about their relationship to money, I think that really goes through, and it will help them make better decisions as they kind of go through.
I think you're spot on in that with that comment. I think that a lot of times people are perhaps not thinking about the quantitative aspect of it. It's really more the qualitative components, like what can I do with this if I don't have it? What does that mean? When I get a bonus, what can I do with that? I think people are always thinking of maybe the outcome of having or not having it, as opposed to the actual dollars themselves.
It's kind of interesting. I think it all boils down to, in a lot of situations kind of in there, specifically around investing, is either fear or greed.
For sure.
Right? And so it's funny that I've talked to people that have had, and I know you've had conversations like this where you're going and you're talking about whatever investment, and they're like, oh yeah, that's terrible. You're like, well, actually, I think it's really good. And you know all the facts and details behind it. And it's because they've lost money in it. So they think that it's terrible fear, and they would never, ever invest in that type of strategy or something like that. Then you have the other side of it, where people are disappointed when their performance maybe isn't 100% of an index, because they want more. So it's either greed or fear. And greed prevents you, that when you own an investment and it drops, it prevents you from selling, especially when something fundamentally is kind of changed, right?
I think that's right. I think it's also important to note that throughout our careers, and you and I have been doing this longer than we would probably care to mention at this point.
Not me, I'm 35.
Okay, well, I'm not. I'm just a tad bit older than that. But I think we hear a lot about fear and greed, and I think the way that you can think of those two terms is that they are actually the two extremes. Most of the time, we want to spend our time kind of in that happiness or satisfaction area, because if you think about it, fear is when you're like, get me out at all costs. I don't care. I've extrapolated out, what's happening, and everything's going to zero. Of course, greed is again, the trees are going to the sky. This is never going down. I'll never have to do anything about it. And, everything is about as rosy as it can possibly be. But most of the time, you're kind of spending that time in the middle of those two, and which is also an emotion. It's just a better one than the fear or the greed.
When you go and you're thinking about behavioral finance and the way that people view or their relationship to money, there's really 4 major themes, right? One of those is overconfidence. market's going to go up, it's always going to go up, right? The other one is cognitive dissonance. That's when you feel anxiousness when you're conflicted with conflicted about your beliefs, right? What you end up doing is you either end up altering your past beliefs or you rationalize why you didn't. Well, I didn't sell because I thought it would go up.
You mean this time is different?
That's right.
We've heard that one.
Then there's the other one is that is regrets, right? Oh no, I would never own XYZ company because I never made money in it, right? Or I would never buy a mutual fund because I never make money in mutual funds, or I would never do that. And then the other one is that the prospect. Oh, this right here, even though it may or may not be a good investment, is going to make me lots of money. And so then it's going to go and I'm going to act on my bias towards that, right? And so let's talk a little bit about those: overconfidence, cognitive dissonance, regret, and prospect. What kind of comes to mind when you think about kind of those four themes with regard to investors and their relationship to money?
One of the signs of overconfidence, and I think this does take an emotional toll, is overspending. It is not uncommon for someone to say, I've made a lot of money in my portfolio and it's all on paper. Therefore, I can spend a lot more money today, sometimes not recognizing that the value of assets goes up and goes down. And when the value of your assets are up, then you feel really, really good. We've seen that not only as it relates to financial assets, but we've seen it as it relates to home prices as well.
Right. What about cognitive dissonance? You feel anxious when you're subjected to conflicting beliefs.
Yeah. So a couple of things there is that it's not uncommon to find individuals or investors that have, they've made their money, buying dividend-paying stocks, and they don't believe in any of the new technologies. So they don't believe in AI, or they didn't believe in the internet back in the day, and they've almost become paralyzed because they're not sure if it's something that they really need to or should be participating in, and it can paralyze them.
Well, I totally agree. I think with regard to cognitive dissonance, I think where kind of that applies is that someone knows, depending on that, their tolerance for risk is moderate, but they see they understand that they don't like a lot of volatility, but they see the opportunity out there. So now they become, instead of maybe having 50% in equities, now they've got 75 or 80% in equities. They turn around and they justify that because they think that the market's the only thing that goes up and you can't have.
Hey, and everybody else owns it too.
That's
so
right.
if I'm going down, I'm not going to do it by myself.
And then you got regrets. That's making decisions based off of past mistakes, right? Or past things that you now regret. Oh, I'm never going to buy a house, buy a second home or I'm never going to invest in real estate because real estate loses money, or I would never buy alternative investments because whatever reason, right?
Yeah, we would run into that sometimes. It's the examples would be when interest rates start to rise. I don't want to buy any bonds because I think interest rates are going to rise and they're going to keep on rising. Same thing happens, by the way, on the other side. When interest rates are falling, it's the same type of thing where it's easy to regret not buying something. One of the things you hear a lot in the investment arena is, I should have bought or I should have sold.
Right.
Or I should have held. I shouldn't have. I sold
I
too early.
sold that, yep.
I never should have sold that. And so, it's very difficult to kind of come to grips with those emotions because they can scar you and keep you from making sound decisions as you go forward.
Yeah, that's exactly right, and that's kind of a form of anchoring, right? Another kind of word or thing to be aware of when you're thinking about behavioral finance, and that is, you attach an outcome or you attach a belief to an investment, thinking that can cloud your judgment of knowing when to exit that investment. And we see that all the time. That's the reason why stocks go up, and then they turn around, they come down, and people are like, yeah, I pretty much, and then they don't want to sell till it gets back to that high number.
Right.
You know, another thing that's really interesting that I do think affects a lot of people is mental accounting. Think of this as playing with the house's money, right? You buy a stock. In fact, I just had a conversation yesterday with a client, and this was fascinating. He was actually, or potential client, he's in the process of completing everything, but he was talking about the value of, he was talking about the performance of an individual security that he had. And he says, what's on here is just completely wrong. I'm like, how do you mean? And he goes, I've already taken all my profit out of it. My returns are much better than this. And I was like, what? He goes, no, I put X number of dollars into it and it went up, and I took, this is just extra, so my return should be much better. I'm like, well, hold on. From a tax standpoint, when you sell that stock, because you reinvested dividends or you bought more as it went up, when you sell that stock, that capital, you have a cost basis there. And it was just really interesting that is mental accounting, is that you have a different value on funds based on how you obtained it. Another way to think about that is lottery winners.
Right.
Lottery winners tend to end up going broke because they were lucky that they got it, and they go through and do it.
Sometimes they forgot that they actually owed taxes on that.
Yeah. The other is self-attribution. That's where success is based on me, but bad outcomes are based on external sources.
I see. So if I made money, I did it, and if I lost money, you did it.
Not necessarily you, but it could be outside. If the government wouldn't have changed that law, if this wouldn't happen. And when you kind of, it means that you're not looking objectively at money. The last one that I think that we'll talk about is familiarity basis. That's when you stick to the things that you know, and then you don't open up that opportunity. So here in Houston, we work with a lot of people who work with energy companies. They became wealthy from concentration, owning their company's stock, and their company's stock may be good. And and may be good, it made them wealthy, they're comfortable with it, they know where it is. But what's interesting about that is if that sector or that industry goes through a prolonged period of negative growth or something not good happening, or that company in particular has serious issues, they still want to own it. And so getting out of it, because they're familiar with it, says, nope, I don't ever want to own it, I'll be just fine.
Right.
And
then they become a patient investor. Is that correct?
Yeah, that's right. And the thing that I think about is that familiarity basis can also, when you push that along, can also mean that you end up only owning similar things. I made a lot of money in this tech stock, so all I want to do is own tech stocks. Think of the Magnificent Seven. Mm-hmm. Right?
Yes. Yeah, absolutely. I think we've run into that over the years many times, and a lot of times that would come from a concentration of company stock within an investor's 401k, and so they just became comfortable owning that. It wasn't uncommon to see, folks that only owned, when I began my career, that only owned automakers. And when you looked at the fixed income side, the bonds that they owned, they were bonds of automakers. Right. So it was like, yeah, they're always going to be fine. They're always going to be good, and none of them are ever going to go down. So you're 100% right. And I guess some of that ties back into that cognitive dissonance discussion that we were having earlier.
When you're going through and you're thinking about these different factors, right? Those different themes and kind of where that is, what are some things that you've kind of bumped into that we kind of see in clients and the ways that you kind of go through and think about how they should be addressed?
Some of them are not always investment related, but they're let's just say they rhyme with it a little bit. And so the example would be on the debt side of the balance sheet, where you have people that have high interest rate debt, and they're always thinking to themselves, I'm going to pay off my house first, and not recognizing that, maybe the interest rate they're paying on their home is much lower than the one that they're paying on their car, which is much lower than the one that they're actually paying on credit cards. And so it's maybe not necessarily thinking about things in the right order.
Or a holistic, how does all the pieces fit together?
Right. And so being able to tie that into the other part. And again, it's emotional. Other emotional things occur when someone decides, I really want that luxury automobile or that big boat or whatever the case may be, and they tend to spend a little bit more than maybe they should have, or more than their earnings would dictate that they are able to do. But it's an emotional thing in that I can afford the cash, I can afford the payment, not really thinking about the long-term effects of paying interest and so on and so forth.
It's kind of like, because the sun's shining today, you think it's shining everywhere. Another way to say that, when it's raining where you are, you tend to think that the entire city is getting rain. Mm-hmm. And that's not the case. A lot of times, at least for me, when I see this raining, I'm like, okay, it's going to be raining today and probably rain all day, right? It just kind of feels like it's there and it's going on. I think people kind of have that feeling with regard to money, with regard to debt. I have the ability to earn money. They think that that's always going to be there without taking into account other factors that can truly go and affect your outcomes.
Yeah, one of the things that you'll note from time to time is that you'll see these kind of consumer confidence type numbers, and some of the things that actually play into that are the wealth effect. So when unemployment is low and the market's high, consumer confidence is high because people feel really comfortable spending money in that kind of environment. But as we know, it can turn on a dime. You can have a 10% correction in the market that occurs over a month. We typically get one every year. No matter what the economy is doing, you get a 10% correction. And during those periods of time, when you see those corrections, all of a sudden consumer confidence drops and people begin to react to it. That's the emotional aspect of it.
And I think that's what's important about behavioral finance, is understanding your relationship to money and kind of trying to step back and say, hold on, make a smart decision, whether it's for the positive or for the negative, either it's taking something on or stopping something, right? Make a smart decision without regard to, like, if your nephew or your child were to call and say, hey, Dad, I'm thinking about buying this boat. This boat costs $100,000. Payments are, I'm financing it for 15 years, and the payments are only $250 a month. What do you think? That's insane. You're not going to take that debt on, son. Wait, right? Or daughter, whoever it goes in.
Yeah, I think if you look over time, markets historically, and if we're just applying it to the capital markets, have historically moved higher more often than they move lower. And for investors, their success has been defined more by what they do when markets are low than what they do when markets are high. And so it's that discussion where, and I think you really keyed in on some of those concepts early on. If you sell ABC stock or ABC investment at a certain price, you're not likely to buy it back at a higher price. And so again, those are very, very critical decisions that people have to make along the way, and all of them are emotional.
Well, and that's the key. I think the real thing is about stepping back as you're going through and taking those biases, or have someone that you work with that can take those emotions away. I'm all the time telling clients, let me take my financial advisor hat off, and this is how I view this. Now let me put my financial advisor hat back on. This is what the numbers tell us. I realize that those seem a little bit different. We need to figure out where it fits for you so that we can help make sure that you're financially successful.
Right. And I think it makes a lot of sense as we head into, again, a presidential election here in the latter part of 2024. People will think about that emotionally. Some people will invest for an emotional outcome there. I think one of the best things that an investor can do is actually take a little bit of inventory, see where they are, and see if if there are things out there that they're likely to react emotionally to, maybe make some adjustments.
Or at least be aware that you have these bias.
Yes.
And understand that when it comes to financial success, there's more than one way to skin the cat, which opens up that opportunity. Do you agree?
100%.
And with that, Mike, thanks. I really appreciate it. This was a lot of fun. I know there were some good bits here that people will be able to take, and hopefully they're biased towards the good side and say this was an excellent podcast.
Nobody ever made a lot of money by being a pessimist.
That's right. And with that, thanks for joining us this week on Wealth Strategies Unleashed with Concenture Wealth Management. We will see you next week.
The information contained herein is intended to be used for educational purposes only and is not exhaustive. Diversification and/or any strategy that may be discussed does not guarantee against investable losses, but are intended to help manage risk and return. If applicable, historical discussions and/or opinions are not predictive of future events. The content is presented in good faith and has been drawn from sources believable to be reliable. The content is not intended to be legal, tax, or financial advice. Please consult a legal, tax, or financial professional for information specific to your individual situation.
This work is powered by Concenture Wealth Management, registered representative of Sanctuary Securities, Inc., an investment advisor of Sanctuary Advisors, LLC. Securities offered through Sanctuary Securities, Inc., member FINRA, SIPC. Advisor services offered through Sanctuary Advisors, LLC, an SEC registered investment advisor. Concenture Wealth Management is a DBA of Sanctuary Securities, Inc. and Sanctuary Advisors, LLC.